China's property market is imploding. In January, Shenzhen-based Evergrande Group was forced to liquidate, owing $300 billion. An estimated 90 million apartments are empty in China, many in underoccupied ghost cities such as Shenyang and Ordos. Other Chinese property developers such as Country Garden, Fantasia Holdings, and Sunac are in disarray. China's economy is slowing. As of September, factory activity in China had shrunk for 5 consecutive months. The International Monetary Fund forecasts that China's long-term growth rate, which was 10% in 2010, is now under 3%. In the 1990s, Japan's growth rate slowed by a similar amount. In September, China took its own bazooka, a massive stimulus involving lower interest and mortgage rates and reduced bank reserve requirements. The Shanghai Composite Index jumped 25%. All clear? Hardly. The rally fizzled, down roughly 10% since October 8, following news of a smaller-than-expected stimulus. On October 12, China's finance minister stated that Beijing will significantly increase government debt to stimulate the economy. Details were sparse. Still, Lan did outline a laundry list of high-priority challenges he vowed to tackle, signaling he would spend some $300 billion of funds that have been earmarked for this year but haven't been deployed. Japan spent lost decades trying to boost its economy with monetary and fiscal stimulus. However, Japanese banks were burdened with non-performing loans, and rather than making structural changes to the economy and writing off these bad loans, Japan ended up with zombie banks that looked good on paper but stopped making new loans. The economy flatlined. Is China becoming Japan 2.0? Let's do the math. The average apartment in China is valued at $200,000, 970 square feet, at $205 a square foot. The 90 million empty apartments might be worth $18 trillion. Construction and purchase loans on these empty apartments are likely in the multiple trillions of dollars and underwater. Yet China's official non-performing loan ratio is reported as a meager 1.6%. That's hard to believe. Chinese economic statistics are notoriously fuzzy, but it's difficult to hide 90 million empty apartments for long. The good news is that China has a high domestic savings rate. Perhaps it can paper over the non-performing loans. However, the economy is still dominated by low-margin, low-productivity state-owned enterprises. Thanks to its now-abandoned one-child policy, China is faced with an aging workforce. Higher productivity enterprises are the remedy for this demographic shift, but these are the very companies are facing restrictions in finance, trade, tutoring, and gaming. That's not smart. Unlike Japan in the 1990s, China isn't yet rich. Official gross domestic product per capita is still below Mexico. The mainland expects a sharp decline in its economic growth. Sound familiar? Add to this Donald Trump's proposed 60% tariffs on Chinese goods, which could mean a significant shift in manufacturing to Mexico, Vietnam, and India. Kamala Harris may also use tariffs against China. The European Union recently imposed 45% tariffs on Chinese electric vehicles. Can China's economy handle this? Tariffs are essentially product-specific currency manipulation. Outbound shipments in September were up 2.4% from a year earlier, decelerating from August's 8.7% pace, according to data released by the General Administration of Customs. China has its own loan problems. The government's debt-to-GDP ratio is nearly 85%. Private non-financial debt is 205% of GDP. Local government debt in China amounted to 90 trillion yuan, $12.49 trillion US dollars. In 2020, 50% higher than the World Bank and IMF estimates. According to a study published on December 22, 2023, by Professor David Daokue Li and Zhang, he of the Academic Center for Chinese Economic Practice and Thinking, accept, Tsinghua University. Of that, China's dollar-denominated debt is about $1.1 trillion. Yet China has made a conscious effort to dump US dollars. Its treasury holdings peaked at $1.32 trillion in 2013 and had fallen to $776 billion this July. China may hold some dollars offshore, but that's still a significant change and dangerous. If you remember the currency crises of 1997 and 1998, South Korea, Thailand, Indonesia, and even Russia were caught with dollar-denominated debt and imploding currencies with no way to repay loans except through a fire sale of assets. The lesson: hold dollars in reserves to prevent a run on currencies. Instead, China is stockpiling gold, oil, copper, and other commodities. Some think these moves are a precursor to a currency devaluation to kickstart its slowing growth in exports. That could wreak havoc on global markets and spark capital flight from China, but this could offer some investment opportunities for those companies that position themselves well in the global trading system, which can take advantage of low-interest Chinese loans, invest globally, and keep their profits offshore to earn more returns. Due to the property mess and low-productivity state-owned companies, Yale economist Stephen Roach tells us, China's growth rate may be unacceptably slow, and no amount of savings is going to free them of the structural problems along the lines of Japan.